Real estate investing is one of the most powerful ways to build wealth while slashing your tax bill. But many investors miss out because they don't understand how the IRS classifies these investors and how to play their game. Today, I'm going to break down the 3 essential things that you need to know as a real estate investor in order to grow your wealth and to cut your tax bill. So the key thing to know is that the IRS does not treat all real estate investors equally. You're either a passive investor, an active investor, or a real estate professional. All 3 having varying levels of tax implications based on their real estate. Passive investor is the bucket that we prefer not to be in. This is where your losses are limited and the amount of deductions that you can take on top of your real estate depreciation is very limited as well. The losses as a passive investor only offset other passive investment gains and losses. This meaning as a passive real estate investor, the losses that you take from depreciation and cost segregation studies can only be used to offset other passive investments such as selling stocks or selling crypto or other passive investment that does not take active participation. The second bucket that you can fall into is the active investor bucket. This is where $25,000 of your losses from real estate are able to offset your ordinary income. This means that by taking depreciation on your real estate asset, you can offset $25,000 of your regular income, such as W-2, or if you had another service-based or product-based business. However, it's important to note that this phases out with income. So once your income level reaches a certain level, you're unable anymore to take this full $25,000 deduction. And the last bucket is the real estate professional. This is where you are viewed in the eyes of the IRS as real estate being your primary active business, and you're able to offset 100% of your income with your real estate losses. This means that it qualifies to be deducted against any other income that you have. However, to do this, there are very strict qualifications that you must meet. And there's 3 major ones that really are the only ones that you should worry about. So first, you need to spend over half your time working in real estate. So this means that you can't spend most of your time in another business and then say that you're also spending a lot of time here and qualify as a real estate professional. It has to be half of your active working time. Additionally, you have to log 750 plus hours of material participation within real estate. And so what this looks like, the material participation part of it, means that you're not just sitting back looking at the financial statements and advising on what is next to be purchased. Rather, you're going in, you're doing the rents, you're collecting the money, you're structuring the contracts, actively vetting the potential renters and things like that, making repairs. All of these would count towards material participation hours. And just a clarification, when I'm talking about these real estate losses, I'm not saying that you're actually losing money on the real estate, but rather that we're creating paper losses by taking a property and doing a cost segregation and depreciating the different parts of the asset. But we'll talk about that in another video, so be sure to subscribe so you can see that one. So yeah, the goal is to be a real estate professional if you want to take 100% losses, but that is very hard to get, and it's definitely not for everybody. However, if you are able to pull it off, there are massive tax benefits. But like I said, you have to meet those qualifications. So the next topic I want to discuss is that not all real estate is treated the same. So there is short-term real estate and long-term real estate. Short-term real estate gets different treatment than long-term real estate. So short-term real estate dealers get all of their income taxed as self-employment income, which means you're subject to the additional 15.3% FICA tax. However, with the long-term investor side and the long-term real estate assets, you are subject to capital gains tax, and you get to enjoy that, which is a lower tax bracket, as well as the depreciation benefits. Another thing to consider with the long-term investor side of things is the 1031 exchange, which allows you to defer the taxable income on your property if you are to sell it. And to do this, in short, you have to sell it and roll it into another like-kind property. But once again, we'll discuss that in another video in the future. If you're in the short-term dealer side of flipping properties actively, it is much harder to qualify for the 1031 exchange, which is something that should be considered in your tax planning strategy. And as with everything else in tax, proper record keeping, proper documentation, and logs of the business activity is crucial so you make sure that you're being classified and able to keep the status of whatever real estate investor status you choose to go with. So the third topic I want to talk about is really the fun part of it and the biggest benefit of real estate investing. So real estate investing isn't just about collecting the checks and receiving that income. Additionally, what you get with that is depreciation, which is one of the biggest wealth builders in the country that we have to offer. Depreciation is a massive tax-free deduction that can generate tax-free cash flow while creating paper losses to offset that income. And on top of the depreciation, another reason is that the mortgage interest is also deductible on your tax bill. And as I mentioned earlier, if you qualify for certain higher level real estate investor status, then you are able to deduct all of that income against your regular income. So what this means is your real estate is bringing you in income, but you're also getting to take depreciation deductions and mortgage interest deductions off of your tax bill. And all of this can offset if you have other businesses. But remember, we need to at least be getting into that active investor status in order to be doing this. So it's crucial to realize that buying and holding properties over the long term builds wealth and creates a massive tax shield for you if you're able to qualify for a higher investor status. Real estate investing is just another game that the IRS wants you to play, and they want you to win at it. The more real estate that you buy provides more housing to people in America, and that's one of the things that the IRS chooses to incentivize us with. Knowing which bucket you're in and how to manage your time and activities can unlock huge tax savings for you. So what you need to do is track your hours correctly, make sure that you're grouping your properties correctly, and use your depreciation wisely by using things like the cost segregation studies. Start small, keep learning as it is a game, and continue to watch your wealth grow while keeping more of your hard-earned cash. If you want to go deeper into these strategies or other wealth building and tax saving strategies, hit the subscribe button so you can be around for future videos, or check out the resources down below in the description. Now go make your real estate work for you. I'll see you in the next one. HP out.